Good evening, ladies and gentlemen, and welcome to another edition of What's Happening. I'm George Binns, and the guest this evening on a return engagement, Frank Bellini, who is claimed to fame as the global warming climate change discussions, and Jim Modugno, who has talked with us in the past about the state of the city. Welcome, gentlemen. How you doing?
Thank you.
Hey,
Just
George.
fine.
Well, this evening's discussion is going to be one based on the stock market. So before we go, I have to put up the disclaimer. We think we know what we're talking about, but for all practical purposes, you really need to depend on some other independent source, and don't blame us for anything you've bought or sold.
I think that's
I think
safe.
that's clear enough, yeah.
Yep.
Yeah.
Yep.
So, want to talk about the stock market, and basically, Frank, it was your suggestion, so where do you want to start with it?
Well, I think the basic question is, why is this an important topic? And it's a topic that can sometimes roll people's eyes back in their head and put them to sleep very easily. But back in the 1990s, when a lot of retirement funds became so-called 401ks, an awful lot more people became investors in the stock market and the bond market too. And by the way, the bond market, you may be surprised to hear, is 5 times as big financially as the stock market. And you never hear much about it, but it's a very, very important investment vehicle. Only in the last 30 years or so have high schools begun to do a little bit of financial education with their students. And I was so glad to have my 3 kids get in on that. They took a little course in personal financing. They learned to balance a checkbook, which sounds trivial. You know, you would think that if you graduated high school with any kind of math, that you'd be able to balance a checkbook. But there's more to it. There's the discipline that it takes to keep up with that sort of a requirement. And that is just as important as having the math skills and being able to do addition and subtraction. So I would suggest to people that it's very important. I got my first rollover out of a pension plan in 1998 when my company got sold, and we had the option to take it, and I took it because I thought I could do as good or better job than someone else, and decided to take up a whole new area of knowledge and learn about this stuff for my own purposes. The amount of money that I got was sort of on par with, the value of a house. And I wouldn't let a year go by without doing something to upkeep my house or to improve it or to maintain it. And I sort of looked at this chunk of money the same way. It's like driving a car with your eyes closed if you don't pay attention to it. And it's almost a guarantee that you're not going to be okay. So that's where I'm coming from with this.
Well, I think that the 3 of us are retired. I'm probably longer in the tooth than either one of you, but that's another story. And I think we've all had our experiences with 401ks and rollovers and the market. And I think as you start to indicate, it's somewhat mystical. And lately, the market's been doing some really funny stuff. And you can get all sorts of advice and counsel just short of real good information from the websites. And I guess, Jim, you've played this game for a while. Do you have any different thoughts on it?
No, I actually like the way Frank started that out. That's pretty much very similar to my experiences. I probably didn't dip into the stock market. I was probably 1979. It was probably the first time that I actually decided I'd buy some stocks. And again, at that time, most of the information you had was in the Boston Sunday Globe section of the business section, where they listed all the stocks and all the particular ingredients. And you have to have a magnifying glass to be able to see it. But I went out and I went to E.F. Hutton over in Salem, because you had to go to brokerage firms at that time. And I bought a couple of stocks in 1979. And that was my first experience with it. And, and then from that point on, I agree with exactly what Frank said. I worked at USM Corporation down here in Beverly at that time, and we had a pension plan, but you didn't have really any choices in it. But as time went on, and all of a sudden, like in the 1990s, the internet is now out there. All of a sudden, I began to educate myself a little bit more about where the options were. I also had some rollovers from companies that I created my own, the 401 fund in a Fidelity account, where I was able to manage it. But I also started developing some rules that I wanted to follow, little things that I learned along the way. And I created a whole list for my two daughters that, they're 30 and 35 now. And, I wanted them to have an understanding of it, because quite frankly, today, there are very few pensions that are out there today. You're either going to have to make it on Social Security, which is just not enough. So you're going to have other forms of income. So the 401 becomes extremely important. To your point, Frank, you have to look at it and you have to pay attention to it. I'm kind of like the extreme, as my broker would like to say to me, that I work with. I look at it every single day. I actually look at the stock market. I see what's trending up and down. And the reason I do it is I have the tolerance to the pain, because I know it's going to go up and down, but I also want to see what's influencing it up and down. Right?
Well, that gets to be the real question right now of what is driving the stock market. And the stuff I've been picking up on is they're blaming an awful lot of this on the Fed with this. We've had a couple of years of it now of very low interest rates, and the Fed is trying to drive the market to really increase the employment or reduce the unemployment. And the things that would bother me are like too many companies are borrowing cheap money and buying back their stock to make their earnings per share look good, because the number of shares drops off, but the earnings aren't going up. And one of the ones that really scared me is I'm reading the AARP magazine, just came yesterday, and they're talking and recommending people look into a robo kind of brokerage firm or consulting firm. So I guess the question is, where do you get good data? And I know, Frank, you're, I guess, a technician. I would probably classify you as.
Yes.
You don't tend to follow the actual workings of the company, but more the trend lines of where the market is driving things.
Yeah, there are two general approaches to following the market. They're called the fundamental approach and the technical approach. And you really need both. You need a little of both. I like technicals because I'm a technical guy, and I believe that the fundamentals will get you to the jungle where you have to hunt, but the technicals will help you find the animals that you want to kill and eat. So you really kind of need both. With respect to what's driving the markets and interest rates, the Fed has indeed kept interest rates low for a long time now, and it's not healthy. However, the problem is that foreign countries are doing exactly the same thing. And in order for U.S. companies to remain competitive with their foreign competitors, you need low interest rates. Some interest rates in European countries have even gone negative in the last year or two, if you can believe that. You give them your money and they give you back less when you go to get it. They take the interest. It's kind of a crazy thing. Brings up the idea that of what I like to explain relative to investing or trading. the concept of risk versus hazard. Now, you would think those terms are synonyms, but they're not really synonyms. Hazard is always there. So if you're driving your car and there are bad drivers out there, like there are around here. There are drunk drivers. There are poorly maintained cars. That is a hazard. But you can't reduce the hazard. That's out of your control. But the risk associated with that hazard, you can reduce. And you can reduce the risk by being a defensive driver. You can stay off the road at 2 a.m. when the bars let out. You can do all sorts of things like that to reduce the risk. And so when you gain knowledge about what you're doing, you allow yourself to gain knowledge about investing. You allow yourself to avoid these high hazard situations and to lower the risk as much as anyone can. A typical IRA or, a typical 401k will have limited investment options. There's typically a Dow fund, a NASDAQ fund, maybe a small cap fund, a bond fund, and a cash fund, and maybe a few other ornaments hung on there. But once you roll over into an IRA with a brokerage like EF Hutton or Fidelity, TD Ameritrade, someone like that, you've got a whole world of options out there. And you really have to educate yourself, get some help. If you want to be a trader like me, you need a mentor. I'm happy to mentor people, but very few people, I think, are mentally prepared or motivated to do exactly that. But if you think you are, let me know. I'll help.
Well, the other thing that starts to get to me is there are more funds than there are stocks. And that
well,
you get into a situation where you got so many choices. I remember there was a demonstration for Congress at one time that somebody put up the Wall Street Journal and threw a dart at the stock market pages and came up with a fund, and they went back and checked it. And it did better than a lot of these so-called managed funds. So
yeah.
The issue comes down to when I think of, there's a lot of stuff out there, but how do you pick the good information or the good suggestions or the good techniques if you're a technical analyst, or what are the right parameters to look at if you're a fundamental analyst? Is EPS the right thing?
Yeah.
And all this kind of stuff.
You gotta take a look at what your goals are and what the time horizon is for your goals. So if you're 20, 30, 40 years from retirement, you should have one set of goals. If you are within 5 or 10 years of retirement, you're going to want to take a hard look and look again as you come closer to your goals and try and minimize your risk a little bit more. And you can minimize your risk by what you invest in or how you invest or both. Stocks versus bonds, for example. Will Rogers, Will Rogers doesn't get enough press anymore, but I love one of his quotes. He used to say, "I'm not so much interested in the return on my money as I am in the return of my money." And that, if you're trying to invest and trying to understand investing, that really hits home. Now, with bonds as opposed to stocks, it's pretty much a guaranteed investment. So you get upfront, you get to know a certain percentage of return that you'll get. And these days for corporate bonds, it runs 1.5 to 2.5%, let's say. With stocks, you're essentially making a loan to a company, and they're taking that money, and you hope that they're going to do the right thing with it, but business is business, and there are a lot of sharks out there, and it's a tough world, and you're playing with professionals, and the goal of those professionals is to take the most amount of your money from you in the least amount of time. That's why you need help. So to be on the safe side, you go to bonds, but you don't get as much return. To be on the more lucrative side, you go to stocks, but you really have to figure out what you're doing. Now, stock indices like the Dow 30, used to be the Dow 30 industrials, not too many industrials in there anymore, with McDonald's and companies like that in there. They're not exactly industrials. The S&P 500 is probably the best representation of the overall market in the U.S. Then there's the NASDAQ, which is kind of tech heavy and a little bit finance heavy, I think. Then there's the small cap indexes where you ostensibly would get more return for your money because there's more room for those little companies to grow larger. But at the same time, there's also more risk with smaller companies at the same time. So when you go ahead,
your take on how do you get good information? How do you get to the point of saying, yeah, that's a good stock I'm going to buy, or that's a stock that's run its course and it's time to take your profits? And
I learned how to read price charts, and there's a couple of references I'll show you here before we get off. But if I could share my screen with you for a moment, I'll show you a couple of stock charts, and you can get the idea of what I'm talking about. So I'm going to show you. Oh, you got to enable me to screen.
Let me try this again. There's more damn buttons to push on this thing.
Yeah, I know. I'm going to show you a chart of General Electric. Now, back in the day, General Electric was a star company, boy, and we all revered it. We all knew what was happening with General Electric. It was one of the great American companies. Can you see that chart?
Not yet.
Not yet.
Okay. Give it a minute to click in, I guess. I have it as sharing. I can stop and try again. I'll stop and I'll start share again. Sometimes if you jump the gun, I think is that better?
Nope.
No, nothing there yet.
Well, we'll see if it shows up. If you look at the GE chart, GE back in the 1980s was valued at $1 or $2 a share. By the
there it is.
By the good. By the top of the NASDAQ bubble here, shut this off. By the top of the NASDAQ bubble here, it was worth $34 a share. Now, there have been splits and things like this, so the valuation may be different, but this is all normalized to current value. It came down from the NASDAQ bubble burst to about $12 a share. It went back up, it doubled to about $26 a share in 2008. Then it dropped again to $4 a share. From there, it went up to $29 a share back in 1917, and it has since fallen to $5 a share. Now, GE has started to try and reinvent themselves again. That's what this uptrend is, and you'll notice this goes back to just to give you an idea of the x-axis here, 1981 through 2021. So, almost 40 years of ups and downs of this company. If you had bought near any of these highs, you would be very disappointed in your current $12 a share. So when I buy a stock, I always look at a chart like this, and I look at it in different time frames. So these are monthly bars showing monthly price fluctuations. You can also do this on a weekly basis, on a daily basis. Day traders can look at them minute by minute, and that drives me crazy. I could never do that. But I do try and play some of these ups and downs with a stock. And at this point, GE is off my radar. I can tell you that. However, one that's on my radar.
Well, before you get off the GE stock,
Uh-huh.
this is a question. Since I worked for GE and had loads of it in my 401k
Yeah.
many times,
Yeah.
the question that comes to mind is, okay, with the dot-com bubble that when that burst,
Yeah.
I could understand companies like Microsoft and Cisco and some of those getting hammered, but GE wasn't a dot-com company, and
Right.
yet they
Yeah.
took a tremendous beating.
Yep.
You get to the same situation in 2007, 2008, when the real estate market
The
tanked
housing
because of
crisis. Yeah.
the funny games they were playing, the ninja mortgages, no income, no job. And again, GE got hammered.
Yep.
And I guess the latest bubble was one that was caused by COVID, and
Well, that
GE
was
got
down.
hammered again, along with
That was
everybody
down
else.
here.
So-
That was down here. This top up here, this was GE's fault. This was GE doing it to themselves.
That's Invelt.
Yeah.
So you
It was,
get to some of these issues, and the question it comes down to is, how do you evaluate something on a company that doesn't seem to fit the problem? Jim, you were about to say something?
well, I was going to say one of the things that I remember distinctly in the GE range was the fact that they had bought some companies, paid top dollar for them. And even at the time they bought them, a lot of people didn't think they were worth that much. And I think when it came to those bubbles, they got penalized because they had bought poorly with some of the things they invested their monies in. And that happens on occasion. But I think charts are important. I follow charts. I also think one of the key things for people is to understand that you should and need to be basically in the market. You need to be in the stock market with your investments in the 401. If you're not in it, you're definitely going to be falling way behind, because the 401k is like, often think of it as being like a three-legged stool, milking stool. You really got to have you're going to have Social Security if it's there. You need to have some fixed incomes coming into you, and you got to have something in that 401k that generate things. So I always say you need to be in it, and so therefore there are different options, like you pointed out, Frank, which I thought was excellent. Stocks. I love stocks, to be honest with you. I'm heavy stocks. Even at my age, I'm heavy stocks because I honestly believe I don't believe in the 60-40 or the 70-30 rules anymore, because of the way things are in society today, and the way the market just keeps moving up, and it goes up and down, but it still moves up in trend lines.
But you're looking at it all the time. So
yes,
you can do that.
Yes.
You have lowered your risk considerably by doing that.
I do, and that's one of the things. And I learned some of those techniques from, my dad said, never trust the guys in the stock market, right? Because
that's for sure.
They're always smarter than you, and they have the information before you. So you have to be constantly watching and paying attention. I also invest a considerable amount of money into muni bonds. Okay. Muni bonds are an excellent way of getting returns, and I'm sitting on returns of 4 to 5% right now still.
Great.
On long-term investments, and then I look for the ones that I buy. I buy the ones that have no federal taxes, no state taxes, no ATM. Yep. ATM, yep. Is that what it is? AMT? I always get them mixed up. But I try not to buy, and I buy them, and and that's another form of income that I have, but I play the stocks, but I have a nice mixture of stocks.
So you're talking about munis, MUNIS, which is short for municipal bonds. And those are issued by cities and towns and states.
Yes.
And those pay an interest rate which is has some of its taxes forgiven or not charged to you, compared to an equivalent interest rate from another company on their dividends or interest from another investment.
Absolutely. And what you do is you buy, obviously you know something about munis too. when you buy the munis, a lot of them, you look at the ratings, but you're looking at those that are guaranteed. You're not taking risky endeavors, right?
Right.
When you
Right.
do those. But
Yeah,
also,
I would stay away from California munis and
I don't go
Illinois
anywhere near
munis.
them.
Yeah,
I stay as close to home as I can, so I understand them.
right.
Right.
That's
So
good.
guys,
so
we are down to the final minutes of this discussion.
Let me
Any
give you
last words, Frank?
let me give you your first trading lesson.
Okay.
If you look at the GE chart here, which we still have up, right?
Yep.
Okay, there's a red line here that you can see. That is a 200-day moving average. And you can see it flowing here with the price as we go through time. Whenever that 200-day moving average turns over and starts pointing downward, we're in for a big dip. And it happened here, even with the COVID dip, not as dramatically as it did back in the housing bubble days and the 2001 bubble days, the tech bubble days, but it did it. It's a signal to get out of the general market, to put your money in cash if that's how you're disposed and you understand what the heck you're doing.
Yep. All righty.
That's my lesson.
Jim, any last words?
My last words would be that you need to do your homework. Get with whether it be Fidelity or somebody else, get some advice on. They can tailor it a little bit to you, what you're looking for and what your needs are and what your risk factors are. And I think at all times, don't try to time the ups and downs, because you can't do it.
Yep.
But you need to be in the market.
So since we're closing, one last reminder that we think we know what you're doing, but you had better go on your own and don't depend on too much of what you've heard. So, ladies and gentlemen, thanks for joining us. We've had a little bit of fun this evening.
Yeah.
Hopefully, you've enjoyed it. And if you have some different opinions, again, as I mentioned in all these shows, at the end, we have the credits. Next to my name is my email address. And send me an email if you want to be on the show or you want to have a different position that you'd like to discuss. And thanks again for joining us, and we'll see you next time.